I've sold about $100,000 worth of Kraken Robotics stock. I've done a lot of videos on Kraken Robotics, and I think it's a great company. Otherwise, I wouldn't have invested in it, and I wouldn't have made all those videos on it. So why did I sell so much stock? Well, I still believe in it, and I still have more than 100,000 left in it. But the reason I sold along the way is I want to hedge my bets. So as you see, over 5 years, it's up almost 1,000%. So I asked Gemini to help me plot this. These are different points when I've sold and at different prices. And if you add it up, my sale proceeds are 104,000. So I did periodically trim, starting in 2025 at 283. Next time I trimmed was 428, and it's over $6 now, which is great. So why am I trimming? So the stocks that I feel comfortable owning in large amounts are stocks where I won't lose money, not stocks where I can make the most money. And I don't mind having a basket of things like this that are lottery tickets like Kraken Robotics or Progressive Planet or Taylor Devices, which did really well for me. But if I'm going to have a large amount of my net worth in a stock and it's going to go down 50, 60, 70%, that's going to be very unnerving because I don't have a regular salary coming in. I have a small pension from my former job as a federal lawyer, and I trade stocks on my own, and I do some other things like consulting. But, I don't have a regular salary coming in where I can just wait it out and, I'll have more money coming every 2 weeks that I can just plow into the stock market. So when something goes up a lot like this, I don't mind selling and rebalancing because mathematically it makes more sense. So most people think that the return on stocks is kind of like this, some are above, some are below, and you'll do fine over time. But the reality is that 3 or 4% of the stocks like Google and Nvidia are responsible for most of the returns when you invest in something like the S&P 500 index. And so if you can pick those few stocks that do really well, you will do great. But if you are picking most of the stocks here which underperform, then you won't do well. So you think it's an average like this curve here, but uh, 3 or 4% of that 500 are responsible for all the returns. A lot of them do worse than average, and there's a lot more that do worse than there are that do better. So your odds of picking a good one are very small, and it takes a lot of work to find a good one like Kraken Robotics, which is why it's kind of painful to sell. But everyone is so bullish on it that it makes me concerned because most people are stupid, myself included. So if you're doing the same thing everyone else is doing, it might be a stupid thing to do. And the conventional wisdom is right most of the time, which is why most people follow the conventional wisdom, because most of the time the conventional wisdom works. So about 90% of the time, doing what everyone else does is the right thing. The problem is that 10% of the time where it's not the right thing to do, that kills you. So I don't want to be in that 10%. And mathematically speaking, rebalancing is not a bad idea. So here's some different returns for stocks and bonds. And as you can see, the return on stocks is much higher than the return on bonds, but stocks are very bumpy. So, you're trading a smooth red line here for a bumpy blue line. And if you can handle the volatility, that's fine. And if you can't, it's a bumpy ride and may tempt you to sell. But look at what happens when you rebalance. So the best return is very lumpy if you invest only in stocks, and the worst return is very smooth, but a lot lower if you invest only in bonds. But if you periodically rebalance, you sort of get the best of both worlds. You'll see that the rebalanced portfolio is pretty close to the 100% stock portfolio, but those big bumps and drawdowns are a lot less than that, so it kind of smooths out the ride. So think of two different scenarios. You were an early investor in Amazon at $1 and you never sold, and you become a billionaire. Or every time Amazon doubles, you sell half your position. So you still keep the same amount of money, but it keeps doubling, and every time it doubles, you sell half and you keep your original position. If you do that 100 different alternate universes, in 99 of those, you are worth tens of millions of dollars. In the one universe where you didn't sell Amazon, you were a billionaire. But in every other alternate universe, you're still worth tens of millions of dollars. You're doing great. Now replace that. Instead of Amazon, you have Netscape, which was an internet darling and went bankrupt. So at one time, it was the fastest growing stock and everybody owned it. Then Microsoft wiped them out. So in that one, if you had sold every time it doubled, you would still be worth tens of millions of dollars. But if you were that guy who held on for dear life and never sold, you would get a big fat zero. Right. So when you buy a stock in advance like this, Kraken Robotics, I don't know if this is going to be Netscape or I don't know if it's going to be Amazon. So one of the things you can do to hedge that is to rebalance to the amount that I am comfortable weighting it in my portfolio, which is about 3 or 4% of my investable assets. So if that position went to zero, I'd be upset about it, but it wouldn't kill me. But if it was a 20 or 30% position, that might affect, whether I am able to do things with my better half and our kid goes to college or not, right? If I lost 30 or 40% of my money, but if I periodically rebalance it, I might not, get the most possible return. But in all alternate universes, I'm still doing okay. So I have three brokerage accounts. I have one with Merrill, I have one with Schwab, and I have one with Robinhood. I have them for different reasons. The one with Merrill I have because when I got the mortgage on my house, I got a better deal on my mortgage if I had my Bank of America and Merrill and mortgage all with the same place. So that's why I have the Merrill account, and it's my largest account. I have my retirement TSP through the government invested in S&P 500. I have one with Robinhood, which gives me the lowest margin of any of these. So Merrill charges me 9%, which sucks, and Schwab charges me 13%, which is outrageous. So I did find a great margin at Robinhood, especially Robinhood Gold. And there's a link in my bio in the description if you want to sign up for Robinhood. If you're going to do anything with leverage, which you probably shouldn't, but why pay 13% or 9% when you can pay 5%? Anyway, I do have Schwab for one very important reason. So there are stocks that I can't trade on Merrill or Robinhood that I can trade on Schwab. So Schwab, I was able to buy Kraken Robotics when I couldn't buy it on Merrill, and now Merrill does carry Kraken Robotics eventually after it already went up. But there's a couple other positions I have like Table Track and Progressive Planet, which I can only buy on Schwab. I can't buy on Merrill or I can't buy on Robinhood. So this is the smallest of my accounts, but it's where I buy the small cap stocks like Progressive Planet, Kraken Robotics back when I first bought it, and Table Track. So if you look at this, the 1 year return, mine is 153% versus 17% for the S&P 500. And the 5 year is still pretty good, 28% for me versus S&P 500, 14%. And part of that is because I had a 50% loss in Alibaba. Screw you, Alibaba. But even with that, if you have enough winners that do really well, you can make up for the pain of some of the terrible ones. And when I say this is the smallest of my three accounts, this isn't some BS $5,000 account that I have where I blow the numbers off and then I use it to pitch my services or something. I don't manage anyone's money and I don't want to. I don't have a monetized YouTube channel. There's people with 50,000, 100,000 subscribers, and they don't have performance nearly close to this or what I have in my other accounts. But they're out there pitching courses and membership tiers and things like that, and that's not something I'm interested in doing. I'm just going through my process of how I invest, and I enjoy getting questions and comments, and I talk about how I invest, not how you should invest. And I walk through my process because I don't want to fall victim to thesis creep. So thesis creep is when you talk yourself into buying something or holding on to something when the story has changed. So if you look at this, there's no PayPal there. I used to have a mid-sized position in PayPal, and then the CEO got fired and the stock lost like 40% of its value. I sold immediately. I still think it might be a good company, but the reasons I bought, the CEO that was in place had a certain plan, and I thought it would take time to work out. And now they have a new CEO, and I don't know if he's got a new plan. But if I talk myself into holding it for a different reason, like, oh well, now it's a new CEO, but it's 40% cheaper. Maybe I should buy more. That's thesis drift, and doing these videos and setting forth the reason that I own something like Kraken Robotics or Table Track or Coupang, which I've done several videos, or Venture Global, that keeps me honest to myself, because the easiest person to fool is yourself. So you have to be ruthless with yourself. I give other people the benefit of the doubt, but I'm ruthless with myself. And if you notice the sizing of these positions, although I did sell $100,000 of Coupang, of Kraken Robotics, I still have $100,000 more. And that's, as I've been trimming, and I've been buying other things. And this sort of looks similar to my main account, which I have on Merrill. The biggest positions I have are not the ones that I think I can lose. I can make the most money. They're the ones where I think I can't lose. So St. Joe is one of my biggest positions. No debt, doing really well. And Fortress balance sheet, and companies like Berkshire Hathaway and Google, which have no debt and a ton of cash on the balance sheet. I don't have Nintendo in this account because Schwab is a jerk broker. And when I buy foreign stocks like Nintendo, which cost me nothing on Robinhood, or cost me nothing on Merrill Lynch, on here they charge me $6.95 for every trade. So unless I want to make a big trade, it's not worth it for me to buy international stocks like Nintendo on here. And even for these small ones, like Progressive Planet or Table Track, it's $6.95 each trade. So I wouldn't recommend Schwab. Their fees are outrageous, and 13% for margin is a crime. And the reason I keep this here, as I said, is it gives me exposure to stocks that are foreign or very low market cap that I can't trade on Merrill Lynch, and I definitely can't trade on Robinhood. But each of them have their purpose. So this one is my account for smaller stock things, and my fun account, let's call it that. My main account is Merrill Lynch, where I have most of my big positions. And if I want to do something with leverage, I use Robinhood, because out of the three, it's much less than Merrill Lynch, and it's definitely much less than Robinhood. So that's my thoughts on this. I mean, it's still a great company. It still has room to move up, but I'm a cheap ass, and at 125 times earnings, that looks a little high to me. So I don't mind taking some chips off the table if I can buy other things that are trading at much cheaper valuations, and I feel no shame about that. You can win a baseball game by hitting home runs, and you can also win one by hitting lots and lots of singles, and then those eventually become home runs too. So that's my thoughts on that. Like and subscribe, and leave questions you want in the comments. And as I said, this isn't investing advice. This is for educational and informational purposes only. If you want to know more about Kraken Robotics, I've done several other videos on that, and then you can check it out there. So I do think, with all the uncertainty in the world and possible future strikes against Iran and other places like Mexico, this will do well, and especially if they keep getting contracts from Anduril. But at 125 times earnings, I feel like a lot of that's priced in, and you can't make a negative comment about this on Twitter or Reddit without getting slammed. So I feel like everyone that wants to buy it has already bought it. So I don't mind holding it and seeing what happens. But the amount that I have now is a position that I'm comfortable holding. If it went down a lot, I would buy more. And if it went up a lot, I would trim more. But I just want to keep that position sizing in relation to the rest of my portfolio. If everything else in my portfolio went up a lot, maybe I would feel more comfortable holding this, because percentage-wise, it would be the same. But, I saw fit to sell it. I've owned it for over a year, And 700% in a year is great. And once you pass that 1 year mark, I have to pay long-term capital gains instead of short-term capital gains, so it's less taxes for me. And had I sold in December, I'd have to be paying taxes in April, but now that I'm selling in January, I don't have to pay taxes until April of next year. Sorry, February. So that's just my thinking on that. Anyway, have a great day, everyone. And hit the subscribe button if you got something out of this, because that helps you see future videos and it helps with the algorithm.